Now, the risk of that is you do need to keep an eye on your portfolio to see if there's any substantial change. So I've talked about FICO as a nice case study.
Oh, right.
They were a great investment until they weren't.
Yeah.
So if you're managing your portfolio on your own, even though the intention is to hold it for a long-term period of time, you do need to keep an eye on these companies. You do need to keep an eye and see if there is a significant change.
Hey, Mike, can you set realistic expectations for someone who gets a plan and then manages it on their own?
Yeah. So I wrote an article years ago, a year ago maybe, and it was called How a Comprehensive Plan Could Replace Your Advisor and Save You Money.
This is on Kiplinger, right?
It wasn't on Kiplinger. That
Oh.
one went on Yahoo Finance and
Oh.
Market Insider, so Business Insider,
Okay.
and a couple of other places. It got kind of syndicated a little bit. We put it as a press release, technically, and a lot of people picked it up. But the point is, many people, if you have a system that you can follow, are fine. So let me give you a couple of examples because this will help illustrate it.
Yeah,
Okay?
please.
Because you want to follow systems, not sentiment. You don't want to wing it. You want to know if the markets go down, you do X, Y, Z. If the markets are up, you do A, B, C. That's how it kind of a system would function. You've already decided your strategy before it happens. Okay?
Yeah.
It's like in chess. I move here. If they respond this way, here's your reaction. If they respond that way, that's your reaction. That's how you play chess. You're not moving and then saying, okay, what happens? And then you're just kind of guessing your way through. Okay.
Right.
You have a strategy that's multiple moves ahead. So for your typical retiree, let's say they've got $1 million saved up or less. Okay. You've got Social Security. Okay. That's pretty easy. At some point, you'll need to turn on Social Security. When you turn it on, that's going to be a concerted effort on 67, 70, 62, or whatever it is. Okay.
Sure.
Maybe you've got a pension, maybe you don't have a pension, but determining when, if you have a time frame to turn on the pension or it just turns on. A lot of them, it's just one time you turn it on when you retire and that's it, and that's fine. Okay. Then you've got to figure out how do you fill in the gaps, cracks, and crevices? How do you need your portfolio to generate income? Now, your portfolio, your investable assets, you've got stocks, bonds, mutual funds, ETFs, buffered ETFs. You've got CDs, treasuries, bonds, not bond funds. You can use fixed annuities or fixed indexed annuities, which a fixed annuity, by the way, is a CD from an insurance company. A fixed indexed annuity, as long as you don't turn on income and use it, it's kind of like a buffered ETF or a structured note from an insurance company. When people hate annuities, it's because they're thinking typically of a variable annuity. Or they're like, oh, they bought it and they just bought a bad annuity. That happens. You can buy a CD today for 0.5% or around 5%, maybe 4% now. Things have shifted.
Yeah.
So you don't want to take a single experience and assume that's the whole thing. But I want to define things as they are, okay? You can buy rental property. If you already have rental property, you can, but you've got to figure out then what portfolio are you working with and how do you take income out when the markets are up and then when the markets crash, okay? Why? So if the markets go up, then you can take income from your profits, you're good to go. If the markets go down and you take income, you accentuate the loss. Here's the quick example. If the markets go down 30%, you need to have a 43% recovery to break even, just to get back to where you were. You don't want to go down on principal, at least for the first couple of years. So if the markets go down 30%, which they do every 7 or 8 years, and then you take out 4%, let's say, because you need to pay the bills, you're now down 34%. Now you need a 50%, 50 recovery just to break even. That might take a couple of years. That's rough.
Well, what did the markets go down earlier this year? Was it like end of March, beginning of April 2025?
Yeah, they went down pretty hard, pretty quick.
Yeah.
Yeah.
They went down. It wasn't 30%, was it? I don't know.
No, let's look it up real quick.
Okay, yes.
Okay, so year to date, top to bottom, it was around an 18, 19% drop.
So that's fairly significant.
Kind of.
Or maybe not. You tell me.
It was a fake crash.
Oh.
So a crash is 30% or worse.
Oh, okay.
A correction is kind of within the 10 to maybe 20% based on how I look at it. And then it recovers in how long? A couple of months? 1, 2 months, really? That's not really a crash. That's a correction. Okay. And then you've got, let's just go over there real quick. And I'm just looking at the S&P 500 for this. You've got the other crash from, let's see, 2022 to 2023. That was slow and steady and rough. That was 20% or so. That's not a real crash. We haven't had a real crash since 2008.
Oh.
And a lot of it is from quantitative easing. A lot of it is from manipulation of the Fed. A lot of it is manipulating our economy. A lot of it is a lot of things that you can't keep doing forever. At some point, we've got to pay the piper. And the same thing happened when you look at 1987, Black Monday. The markets crashed quickly, and then they recovered. And then we had 1990. It was a quick crash again when Iraq invaded Kuwait. We manipulated things, had a new economy, the .com, the internet, and that grew exponentially for 10 years, and then we had 10 years of nothing. Do you see the parallels here? So the point being is you're not looking to just outgrow your assets. What do you do when the markets crash? We call it a reservoir. We're kind of starting now to call this a bear market protocol, but here's what it is. So when the markets go down, you have to have, in our opinion, a part of your portfolio that is principal protected.
Meaning?
It can't lose money.
Okay.
So if, let's say, just for easy math, 40% of your portfolio wasn't in bond funds, but let's say it was in buffered ETFs. Okay, a buffered ETF, in most situations, if it's a max buffer, so 100% buffer, and these do change from time to time, but if the markets go up, let's say 7%, or you can get up to 7% of the growth, but no downside risk. Okay, that's not always downside risk. That's just sometimes it can go from like 100% to maybe 60% buffer, things like that. It fluctuates. I don't want to call it principal protected. It can change, but for the most part, the downside's protected. Okay. Probably making this more complicated than it needs to be. But you've got, let's say, 40% in something that if the markets go down at the end of the year, it kind of resets. You don't lose money, but you've got up to 7% of the growth.
Okay.
So if the markets go up 10%, you get 7%. If the markets go up 4%, you get 4%.
So it's a little bit of a trade-off. Like, hey, I won't lose a ton, but that prevents me from gaining fully. But it's your trade-off.
Yeah, it's not going to make you rich. It's going to help you stay rich. It's going to help you keep your wealth. Okay. So if the markets go down, and you've got 40% of your portfolio that can't lose money, that means your portfolio hasn't lost as much as the market. That's a good thing, number one. Okay. If the markets go up, it's still made money. That's a good thing, number two. But if the markets go down and you need income, that's where you take your income because it allows the other part, the 60% of your portfolio, to have time to recover. You see how that works?
Yeah, and this is especially good for people who are retired and need to draw income, right, from their... If it's someone younger and the market's crashed, hey, you keep working.
You don't really need this.
I don't need this money until 30 years from now, right, or 20 years.
Oh, well, if the markets are crashing, you'd be buying. You're buying everything on a discount.
Right.
So you have a part of your portfolio in retirement protected, and here's the protocol. It's real simple, and so I think a lot of people can do this. When the markets are down, this is where you take income. When the markets are up, you take income from these places. There's a little bit of everything. Most people can handle that. And when we build a plan, we write out those instructions. When the markets are down, this is your reservoir. This is your bear market protocol. Do this. And because we can ladder things out between buffered ETFs, maybe structured notes, those are a bit more complicated. Maybe some fixed index annuities because and this is, I'm not quoting any sort of product, but if a buffered ETF can offer you up to 7% with no downside risk, maybe a fixed index annuity could offer you up to 10% of the S&P, but no downside risk. And the difference is a buffered ETF is liquid, a fixed index annuity is not. So it can give you a little bit more upside, but you got to keep it in there for a little bit longer. So you have to ladder out liquidity and things like that. That's our job, is to set that up. And then we can say, hey, you don't need to pay us ongoing fees. This is just do this. Now, for someone that's $1 million or less, the fees that you might be paying your advisor, you might not be getting the value worth the fees because it's a very difficult situation when everyone's kind of promised roughly the same relationship, but some are paying 3 times more in price on fees. They're either going to get more attention or they're just paying more for the same service. But if you're paying less, you might not get as much attention when you really need the attention. Now, whether you realize that or not, I mean, ask yourself, when's the last time your financial advisor has called you in to review your taxes, to project your income for the next year on how you're going to take your income in a tax efficient manner, to review your brokerage account and the different non-qualified positions and how they might affect your capital gains and your Social Security taxes and your income taxes. And are there opportunities to take some income from a long-term position within a 0 or 15%? When's the last time someone's really done that and gone through it? Probably not. So you might be paying a fee to have them manage a portfolio, but maybe you could manage a portfolio on your own that's very similar. Again, you follow certain instructions. Buy these positions and don't touch them for a while. And when the markets go down, you take income from here. When the markets are up, you take income from there. Most people seem to be able to do that. It's very simple. And then if you need help, if you need an update, you just pay for our time or whatever advice. I mean, it's the open market. You can hire any advisor that's willing to do it as a fixed fee. It's just most don't.
Right.
Most advisors want the ongoing relationship for 1% or 2% of your assets, and they keep you in the market. So for people that have $1 million or less, getting a plan set up to where you just follow the instructions and then come in for the oil change or the update or whatever you want to call it, might be actually a really good option for you. And you could buy some annuities to guarantee kind of your Social Security plus a little bit extra, just to kind of guarantee that foundation, and then have these other strategies on, here's the portfolio. Here are 10 stocks you're going to buy. Here's the indexes you're going to buy. Just hold these positions. Okay. Now, the risk of that is you do need to keep an eye on your portfolio to see if there's any substantial change. So I've talked about FICO as a nice case study.
Oh, right.
They were a great investment until they weren't.
Yeah.
So if you're managing your portfolio on your own, even though the intention is to hold it for a long-term period of time, you do need to keep an eye on these companies. You do need to keep an eye and see if there is a significant change and if you need to make a change in your portfolio or not. Okay?
And so your advisor could check in, or you.
If
How
you
does
are
that
managing it yourself, it's your responsibility.
Oh,
That's
yeah.
the risk.
Yes.
So you're not paying fees. You've got a good system. And maybe your portfolio is just on indexes, so you're not having as much risk to keep track of companies.
Yes.
Maybe you do have a couple of companies. But maybe those companies are like, I don't know, Microsoft and Allstate. Those are maybe not as volatile companies as, take your AI stock pick as
Sure.
example.
Sure.
Some could argue that Microsoft is kind of an AI-like company, but they've got a lot more else. They got a lot more going on.
Right.
So you've got that kind of situation that you'll need to understand. What was the question again?
Yes.
Oh, realistic expectations for someone who gets a plan to manage it on their own. I think most people can do it on their own, even without a financial background, because at least for us, the instructions are so clear. Because they have the opportunity to also come in for one time. You're just paying us, like you'd pay your CPA an hourly rate, pay us an hourly rate for the updates. And maybe you check in every 2-3 years or so. A lot of those are pretty simple situations. But you have to be responsible for keeping an eye on your portfolio, which means you have to build a portfolio that you're comfortable maintaining.
And then follow the protocol.
Follow the protocol, because you should. If you're looking to have a plan built for you, odds are you probably don't want to be a trader, that you're buying and holding these positions for a long-term period of time. Odds are that there is some sort of income mechanism that's helping you structure out your income for the first 5 to 7 years. So, here's an example. Maybe your first year income comes from a CD or a treasury or a money market because you're retiring next year. The CD or the bond instrument matures, and that's your income for that year. And then maybe in 2 years, you've got a 5-year payout from an insurance company. It's not a lifetime income because you don't want that for inflationary reasons, but maybe you got a 5-year payout from there. At that point, you hold the securities in the market for now 6 to 7 years, and you've got your income structured, so you don't even need to see the advisor really until maybe year 3, 4, or 5. And then you come back in, get a checkup, and then you move on.
Right.
And this is so foreign to the financial services space, but it's the honest truth. You could do this. You can trade on your phone. You can manage a portfolio on your phone. You can ask Grok or ChatGPT for market updates, and it's pretty good about accurate assessments. I'm not saying you should take trading advice for it. You're buying positions in indexes with the system to hold it. But this might come as a shock to a lot of people, but it's the honest truth. Now, if you have over $1 million, your situation probably gets a little bit more complicated from taxes. Tax laws are changing, or where you take it just takes more work. Where do you take your income to maximize your efficiencies in the market, in the income, and so on in a shifting environment? That's where, in my opinion, it starts to make more sense for a net of fee performance. Are you able to get more out of your assets by paying a professional than trying to figure it out on your own? TurboTax isn't really going to do that for you. They're going to tell you what happened. They may not show you as well of what could happen in the future. And the tax planning softwares are quite expensive. So you have to ask yourself, what am I really paying for? And is the plan going to set me up for success? Can I manage it on my own? Or is it worth spending money? And I think for a fixed rate, I mean, how much does it cost? How much does it cost to do the job? That is the most honest question. And that's what people should be paying, not a participation award of the total assets that you've saved, because they're going to charge you more because you saved more. That doesn't feel right to me personally.
Right. Yeah.
Any follow-ups on this, or
No,
do
I
we nail
think,
it?
Yeah, we've set it up so that to put a cap on it. I mean, if you feel like, hey, I think my situation is, I don't know, basic enough, is that the right term? But I can go in,
and simple
enough.
is good. Boring is good.
Yeah. If it is, then I get this one-time advice from a professional, help me design this plan, and then I just stick to the protocol for a decade or more, and it's doable.
It is doable.
Yeah.
People are smarter than they give themselves credit to. They just need a good guide to at least get them in the right direction.
Yes.
The people that are calling, at least coming into our office, they're smart people. They don't have a financial background, but they're smart people.
Mm-hmm.
And so when you can just when you can decrease the learning curve and just say, here's how it works, here are the risks, they go, oh, that makes sense. Here's how you do it. They say, oh, I can do that. It's a very cool experience.
Yeah.
And for those that just want someone to do it, that's fine too.
Yep.
But you should have the option of that you can DIY your plan, that you can do it with someone. It's the done for you option. We're going to build a plan for you and then teach you how to fish. Or the done with you, the ongoing relationship, where it's just done, but you're a participant of it.
I like it.
That's the reality here. Hey, thanks for watching this video. Make sure that you like and subscribe first, and then go to www.retireontime.com to grab a copy of my book, How to Retire on Time, take a few courses about retirement, join my newsletter, and so much more. Now, if you want to work with one of our advisors here at Kedrick Wealth, who can help you put together a retirement plan that's designed to last longer than you, just click the button, Get Started. Everything we do is intended to help you retire on time. We hope you enjoy, and we'll see you in the next show.